Good morning, welcome to class. Today we are looking at Unit 2 of the EdExcel HNC and HND program. The title of the unit is Managing Financial Resources and Decisions. This unit is specifically designed to help learners to understand how financial resources is managed in an organization to achieve their aims and objectives. I will urge all learners now to focus on the board, and let's move on with the aim of the unit as well as the content of the unit. If you can see from the slides, the first thing we'll look at is the aim of the course. The unit provides learners with an understanding of where and how to access sources of finance for a business and the skills to use financial information for decision making. Students undergoing management courses, business courses, are expected to at least understand the basic sources, uses of financial information in order for you to achieve success. The unit has about 4 main learning outcomes. The first one is to understand the sources of finance available to a business. Number 2, to understand the implications of finance as a resource within a business enterprise. The third one is be able to make financial decisions based on those financial information you have. And the last is to be able to evaluate the financial performance of a business venture. The learning outcome 1, we have 3 main assessment criteria. This assessment criteria is to be achieved by all learners who are expected in this course. The first assessment criteria is to identify the sources of finance available to a business, to assess the implication of different sources, and the last and not the least is to evaluate appropriate sources of finance for a business project. The first thing we'll look at today is what is finance. And I believe lots of us are pondering on this topic. Finance simply means to obtain money for the purpose of managing a business. It means money or liquid resources such as convertible assets, assets you can dispose and easily convert to cash, the management of revenue, money and credit, the management of banking and investment activities such as shares and savings as well. It includes or involves saving and lending money to borrowers or borrowing from creditors, risk management, resource allocation and management, profit and loss. This is what we mean by finance. Why do we need finance? Financing of a firm means providing money for investment in the form of fixed asset and also in the form of working capital to meet the day-to-day requirement of the financial needs of the business. It could be needed, for example, to start up a business, to meet the problem of cash flow, buying some new equipment or machinery for your business, setting up a new plant, buying another business, merger, acquisition or takeover of a business, and ability to cope with debts. There are two sources of finance. We have the short-term source of finance and the long-term sources of finance. The short-term sources of finance refer to money that is needed to finance a business, usually that lasts for less than 1 year. Such finance is generally used to manage the day-to-day operation of a business. The long-term sources of finance refer to finance that is needed over a long period of time, over 1 year, if possible for many years, in order for your business to remain solvent, compete and survive in the business environment. Before we move ahead with the sources of finance, it is possible for us to classify businesses according to ownership and legal requirements. We have limited liability companies. We have public limited companies. Examples include NatWest Bank, Barclays, Microsoft, Facebook, eBay. These are companies that can easily be traded in any stock exchange around the world. We have the private limited companies. Examples include companies such as New Look, Warburton's in the UK, Aldi, IKEA, Virgin Group, and Shell Limited. As well as we have the sole trader, the partnership, and the charitable institutions. All these businesses source their finance from different areas. So we look at the internal and the external sources of finance used for a business, and that will meet the requirement for assessment criteria 1.1 and 1.3. Take a look at the internal source of finance: owner's investment, retained profit saved up over the years by the owner of the business, sale of stock or inventory to raise finance, the sale of fixed assets, and debt collection from those owing you. These are all internal sources of finance. We can look at the advantages and disadvantages from money or retained profit from the owner of the business. One good advantage of using money saved up over a period of time is you don't need to repay the amount, and no interest cost is payable. However, we look at the disadvantages as there is a limit to the amount you can invest, because there is a limit you can save as compared to borrowing from the bank. We look at the retained profit as well. Which is we've discussed earlier. Now we move on to the sale of stock. This money comes in form of selling unused stock in your business. This is what happens in the January sales. For example, when there are inventory left in the shop, they can be disposed of as soon as possible to raise money for your business. The very good advantage is quick way of raising finance. As customer buys the stock, you can easily raise money to invest in another stock. By selling off stock, it reduces the cost associated with holding them. The disadvantages are businesses will have to take a reduced price for the stock. Let me explain this point. If your business needs an urgent capital and you wish to sell off your inventory, it is possible to discount the stock value in order for the product to sell as soon as possible. Let's move on to the next one, the sale of fixed asset. This money comes from selling off fixed assets such as a pieces of machinery, your cars, your building, office equipment. There is also a limit to the number of fixed assets a firm can sell off. However, there are good advantages. It's a very good way to raise finance from an asset that is no longer needed. Okay, for example, there are office equipment such as used computers that are not needed any longer. You can sell them off on eBay or auction them off to raise some capital. The disadvantage of that is some businesses are unlikely to have surplus asset to sell, and this can be a slow method of raising finance for your business. Another source of finance is debt collection. A debtor is someone who owes a money to a business. A business can raise finance by collecting the money owed from debtors. This is a short-term source of finance. Look at the advantages. No additional cost in getting this finance. It is part of the business normal operations. However, this depends on the efficiency of debt management in your business. Let's take a look at the disadvantages. There's a risk that debt owned can go bad and therefore not be repaid. There are evidence available in theories and literature that most of the debtors can turn to bad debt unrecoverable. That means this debt can never be recovered and therefore written off as a bad debt in your balance sheet. Take a very good look of this case study. I've given you a case study. The name of the company is called Purely Organic Limited. Purely Organic was set up with initial capital of £4,000. However, the company decided to expand into the high street. The owners were forced to sell their home in order to keep the company solvent. Tony and Eleanor moved into rented accommodation nearby. So the company's capital include the initial investment from the owners of the business, which is their capital, as well as the proceeds from sale of the owner's house, which is fixed asset. This experience led them to believe that when the next expanded Pure Organic, it should be on a debt-free basis. That means if you own a fixed asset, you can easily raise money without any cost implication tied to the source of the finance. Let's move on to the external sources of finance for a business. We have been able to provide about 5 or 6 external sources of finance. They include bank loan or overdraft from financial institutions, additional partners in case of partnership business, share issues to the public, leasing of premises, the use of hire purchases, mortgages, trade credit, and government grants. Let's look at the items one by one. Take a look at the bank loan. This is money borrowed at an agreed rate of interest over a set period of time. This is a medium or long-term source of finance. A very good advantage is set repayment and spread over a period of time, which is good for budgeting. That means you are given a set amount of time to pay back the money. It is possible for you to sell off your goods, purchase with these loans, and pay back as at when due. However, disadvantages can be expensive due to interest payment. Some of us borrowing on a variable interest rate, you might observe or notice an increase in the interest rate set by the central bank. Bank may require security on the loan, therefore you might be required to provide a reference, credit checks, security using your own property or that of a partner. And it is difficult to get security to borrow substantial amount of money for a capital project. Bank overdraft. The bank overdraft is a short-term source of finance. This is where the business is allowed to be overdrawn on its current account. This means they can still write checks even if they do not have enough money in the bank account. The good advantage here is it is a good way to cover the period between money going out and your cash inflow. If used in the short term, it is usually cheaper than a bank loan. Most banks provide overdraft at an interest-free basis. However, disadvantages: interest is repayable on the amount overdrawn, depends on the agreement you have with a financial institution, can be expensive if used over a long period of time, and bear in mind there are additional charges if this overdraft is not repaid as at when agreed by you or the lending institution. Let's move on to additional partners as a source of raising money to finance your business or a capital project. This is a source of finance suitable for a partnership business. The new partners can contribute extra capital based on the agreed percentage of profit and loss sharing. All this must be documented to avoid any legal implications. A very good advantage of using additional partners as a source of finance is it doesn't have to be repaid. No interest is payable. However, diluting control of the partnership means it is a big disadvantage because the additional partner might be interested in controlling the business. Profit will be split in more ways. That is a very, very big disadvantage. But however, you can save yourself from interest rate, as money contributed from other partners will help you to finance your business. The issue of shares are majorly from the public limited companies through various stock exchange all over the world. This is sources of finance suitable for a limited company. Involve issuing more shares. This is a long-term source of finance. A very good example is Facebook. Last year, Facebook went public by issuing shares to the general public, and they were able to raise an IPO worth billions of dollars. A good advantage is doesn't have to be repaid. No interest is payable. However, profit will be paid out as dividends to more shareholders. That means those that purchase the shares, you need to pay out dividend. Ownership of the company could change hands as majority of shareholders can decide to take a significant control in your business. External sources of finance, one of them is called leasing. This method allows a business to obtain assets without the need to pay a large sum upfront. Leasing is like renting an asset or a property. That means you are allowed to pay some amount of deposit while you make use of the property. This is a medium-term source of finance. A very good advantage is businesses can have the use of up-to-date equipment immediately. You can lease machineries, you can rent cars, you can lease a building for 5 years or 10 years to meet the growing needs or expansion of your business. Payment are spread over a period of time, which is good for budgeting. However, look at the disadvantages. Can be expensive. The asset belongs to the finance company, so therefore the asset is not yours. Hire purchase is another source of finance. This method of finance allows a business to obtain assets without the need to pay a large sum upfront. It involves paying an initial deposit and regular payment for a set period of time. The main difference between hire purchase and leasing is that with hire purchase, after all repayments have been made, the business owns the asset, which is very good. You are allowed to own the asset with a little deposit now and pay off the remaining amount over a set period of time. The advantages are businesses can have the use of up-to-date equipment, payment are spread over a period of time, and that gives you opportunity to save up and pay off at once. Once all repayments are made, the asset belongs to the business. The disadvantages is or are it is expensive method of raising money, and there are penalty charges for not meeting up to the agreed plan repayment. Mortgage, as we all know, is obtaining a loan over a long period of time, and money spread usually 20 years, 15 years, up to 30 years. A very good advantage is business has the use of the property. Payments are spread over a long period of time, and once all repayments are made, the business will own the asset. Disadvantages is very expensive way of getting money because of the variations in interest rate, and assets can be repossessed if you do not meet up to the agreed repayment plan. So therefore, businesses are advised to ensure regular payment to their mortgage account. Trade credit is very common way of raising money. Lots of creditors are giving businesses credit facilities, especially from suppliers and the providers of goods. It is a system where you typically buy goods and you pay, for example, in 30 days time. However, this is a short-term source of finance. The advantage is business can sell the goods first and pay them later. Goods for cash flow. No interest charge if money is paid within the agreed time frame. And the disadvantage is discount given for cash payment will be lost. Businesses need to be carefully manage their cash flow to ensure they can offset their short-term needs of finance. Government grant is one way of raising finance. In the UK, there are lots of government grants, and in the EU as well, that can help you to start a business. The advantage, you don't have to be repaid. However, some of them can be repaid. Certain conditions may apply, e.g. location, and not all businesses are eligible for government grant. We have finished the assessment criteria for 1.1. Therefore, we are moving to 1.2 to discuss the implications of different sources of finance.